Investing for beginners. So before we get started, make sure to hit that like button, also subscribe to my channel. The investment landscape can be extremely dynamic and ever-evolving. But those who take the time to understand the basic principles and the different asset classes stand to gain significantly over the long haul. Cash. A cash bank deposit is the simplest, most easily understandable investment asset, and the safest. It not only gives investors precise knowledge of the interest that they'll earn, but also guarantees that they'll get their capital back. On the downside, the interest earned from cash socked away in a savings account seldom beats inflation. Certificates of deposit, CDs, are less liquid instruments, but they typically provide higher interest rates than those in savings accounts. However, the money put into a CD is locked up for a period of time, months to years, and there are potentially early withdrawal penalties involved. Bonds. A bond is a debt instrument representing a loan made by an investor to a borrower. A typical bond will involve either a corporation or a government agency, where the borrower will issue a fixed interest rate to the lender in exchange for using their capital. Bonds are commonplace in organizations that use them to finance operations, purchases, or other projects. Bond rates are essentially determined by interest rates. Due to this, they are heavily traded during periods of quantitative easing, or when the Federal Reserve or other central banks raise interest rates. Mutual funds. A mutual fund is a type of investment where more than one investor pools their money together to purchase securities. Mutual funds are not necessarily passive, as they are managed by portfolio managers who allocate and distribute the pooled investment into stocks, bonds, and other securities. Most mutual funds have a minimum investment of between $500 and $5,000, and many do not have any minimum at all. Even a relatively small investment provides exposure to as many as 100 different stocks contained within a given fund's portfolio. Mutual funds are sometimes designed to mimic underlying indexes, such as the S&P 500 or the Dow Jones Industrial Average. There are also many mutual funds that are actively managed, meaning that they are updated by portfolio managers who carefully track and adjust their allocations within the fund. However, these funds generally have greater costs, such as yearly management fees and front-end charges, that can cut into an investor's returns. Mutual funds are valued at the end of the trading day, and all buy and sell transactions are likewise executed after the market closes. Exchange-traded funds, ETFs. Exchange-traded funds, ETFs, have become quite popular since their introduction back in the mid-1990s. ETFs are similar to mutual funds, but they trade throughout the day on a stock exchange. In this way, they mirror the buy and sell behavior of stocks. This also means that their value can change drastically during the course of a trading day. ETFs can track an underlying index, such as the S&P 500 or any other basket of stocks with which the ETF issuer wants to underline a specific ETF. This can include anything from emerging markets to commodities, individual business sectors, such as biotechnology or agriculture, and more. Due to the ease of trading and broad coverage, ETFs are extremely popular with investors. Stocks. Shares of stock let investors participate in a company's success via increases in the stock's price and through dividends. Shareholders have a claim on the company's assets in the event of liquidation, that is, the company going bankrupt, but do not own the assets. Holders of common stock enjoy voting rights at shareholders' meetings. Holders of preferred stock don't have voting rights, but do receive preference over common shareholders in terms of the dividend payments. Real estate. Investors can acquire real estate by directly buying commercial or residential properties. Alternatively, they can purchase shares in real estate investment trusts, REITs. REITs act like mutual funds wherein a group of investors pool their money together to purchase properties. They trade like stocks of the same exchange. How to invest sensibly, suitably, and simply. Many veteran investors diversify their portfolios using the asset classes listed above, with the mix reflecting their tolerance for risk. A good piece of advice to investors is to start with simple investments, then incrementally expand their portfolios. Specifically, mutual funds or ETFs are a good first step before moving on to individual stocks, real estate, and other alternative investments. However, most people are too busy to worry about monitoring their portfolios daily. Therefore, sticking with index funds that mirror the market is a viable solution. Stephen Goldberg, a principal at the firm Tweddle Goldberg Wealth Management and longtime mutual funds columnist, further argues that most individuals only need 3 index funds, one covering the U.S. equity market, another focused on international equities, and the third tracking a broad bond index. More hands-on investors, however, may want to choose their own asset mix when crafting a diversified portfolio that fits their risk tolerance, time horizon, and financial goals. This means that you can try to capture excess returns by tilting your portfolio weights to favor certain asset classes, depending on the economic environment. What are the different asset classes? Historically, the 3 main asset classes are considered to be equities, stocks, debt, bonds, and money market instruments. Today, many investors may consider real estate, commodities, futures, derivatives, or even cryptocurrencies to be separate asset classes. Investment education is essential, as is avoiding investments that you don't fully understand. Rely on sound recommendations from experienced investors, while dismissing hot tips from untrustworthy sources. When consulting professionals, look to independent financial advisors who get paid only for their time, instead of those who collect commissions. And above all, diversify your holdings across a wide swath of assets. What do you think about our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.